Hello, so this is on what is a stock market crash and why does it happen? Stock market crashes happen with some regularity about every 8 years for the last 100 years. While that may not seem very frequent, their effects on the market can last for several years. You only have to experience one stock market crash as an investor to understand how scary they can be. The good news is that following every stock market crash over the last century, there has been a full market recovery that has taken the market to new heights. If you like scary roller coaster rides, you should do just fine through the next stock market crash. So, what exactly is a stock market crash? A stock market crash is an extremely and rapid sell off of stocks that often occurs without notice, as measured by the market indexes. Dow Jones Industrial Average, Standards and Poor's 500, and the NASDAQ. A steep decline in the market becomes a crash when it falls more than 10% from its 52-week high in a day or two. The difference between a stock market crash and a market correction. A stock market correction occurs when the market falls more than 10% over a few weeks or months. Market corrections occur every couple of years, so the more infrequent stock market crash could be considered an accelerated market correction. Market corrections of any durations are part of a natural part of typical stock market cycle that allows the market to consolidate after significant and substantial and sustained gains before moving on to higher highs. Most stock market crashes have triggered a bear market, which occurs when stock prices fall more than 20%. For example, the 1929 stock market crash, which marked the start of the Great Depression, lasts 3 years, and it took 2 decades for the stock market to recoup its losses fully. The 2008 stock market crash that coincided with the financial crisis led to a 2-year bear market with a severe recession that led to the longest and strongest stock market recovery in history. One of the shortest stock market recoveries occurred in January 2018 after the market crashed 12% over a week and a half. Within 2 months, the market had fully recovered its losses and went on to record highs. The 2020 coronavirus crash was one of the most severe market declines on record, with the DJIA experiencing 8 of its 10 most significant single-day point declines from February 24th through March 17th. The stock market went from historic highs to full-scale bear market within 2 weeks. Stock market crashes have a global reach. Nearly all stock market crashes have been global in nature. In the last few decades, the global markets have become so intertwined that when a large economic power such as the United States, China, or the Eurozone sneezes, really, the rest of the world catches cold. The global stock markets are especially sensitive to the U.S. stock market. For instance, the 1987 crash, also known as Black Monday, sheared off more than 22% from the S&P 500 in one day. Out of 23 global stock markets, 19 had a decline of more than 20%. In most cases, it has been a U.S. stock market sell-off that has led to steep declines in global markets. In some cases, the U.S. stock market has reacted to a major sell-off of global markets. For instance, in January 2016, the Chinese stock market experienced a steep sell-off of 18%, triggering a sell-off in the DJIA of 8%. In August 2011, global markets, including in the U.S., reacted sharply due to fears of contagion of the European sovereign debt crisis. So why do stock market crashes happen? In a word, panic. In many cases, an unexpected economic event causes a stock market sell-off. In 2008, it was a financial meltdown led by the collapse of the Lehman Brothers, the giant investment bank. In 2020, it's a fear of a global recession brought on by the coronavirus pandemic, both crises triggering market sell-offs, but it was investors' panic that accelerated them. With more recent crashes, those that occurred in 1987, 2001, 2008, 2018, and 2020, it has been the use of programmed high-frequency trading that sparks the panic. Programmed trading relies on mathematical algorithms and computer programs to trade stocks. When algorithms pick up on certain trends, they can kick in with program selling, pushing the market down very quickly. Excuse me. So what to do when the stock market crashes? For investors, a stock market crash can be downright horrifying, but the worst thing you can do is panic with the herd. By the time you can get out of the crash, the high-frequency traders have already done the damage. But it's just a loss on paper. If you sell, you lock in your losses, and it can take years to recover. With every stock market crash, the markets have not fully recovered, but they have always gone on to higher highs. The best course of action is to develop a sound long-term investment strategy based on your specific objectives and risk profile. If your profile is properly diversified, it can withstand the shock of a short-term market declines on its way to generating positive long-term returns. So, thank you for watching.